Hello. What we're going to do now is finish up our setting up of projections for Sahali's CFO, and we're going to project out for a couple years and see what happens to the cash position of the firm if they introduce this dividend, and see how much the dividends can be expected to be in each of those 2 years. So without any further ado, let's jump back in and get to the exciting conclusion.
Okay, so we're going to need to project our two roll forward equations, our income statement and our balance sheet. So let's start with the PPE roll forward and just make sure we know how we're going to do this. We're going to follow our general PPE roll forward equation, that PPE net beginning of period minus where plus additions to PPE equals end of period. So in terms of depreciation, we know average 10-year life, so depreciation is going to be 10% of beginning of period net PPE. In this case, we don't know the target CapEx, but we're going to know everything else because the CFO feels like they have to wind up with net PPE equal to about 100% of TTM sales. So knowing that, knowing the PPE net they started with, knowing the depreciation, we can always solve for the CapEx. So next up will be projecting income statements, and the CFO has told us that she feels that the growth is going to be 10% for the next 2 years. And then again, for any account on the income statement, we have to project that we don't have a formula or a CFO/board of directors dictate for. We're going to use that constant percent of sales assumption. Okay, so when sales grow by 10% into the first year we're projecting, that'll be 110 million in sales. We're going to expect COGS to be 68% of 110 million. And then with depreciation, that's part of our PPE roll forward equation. So we'll project depreciation with that. With SG&A, even though we know it's not perfect, it's a relatively small amount, we're going to project that as a constant percent of sales. So in year 20x1, it's going to be 10% of 110 million in sales, or 11 million. And then our interest is, our RD is 7.25%, and we'll just multiply that by the beginning of period debt to get our interest expense going forward. And similarly with tax, we'll just take right off of the year's income statement the earnings before tax and multiply that by the tax rate of 33%, and then we'll work our way down to the net income for the year. And next thing we're going to want to project is our equity roll forward equation. And that again is equity beginning of period plus net income minus dividends plus paid in capital equals equity at the end of the period. And the dividends, they haven't been issuing dividends, but going forward, they're going to have that payout ratio of 15%. So 15% of net income is what they want to try for with dividends. It may or may not work, but that's the analysis we're doing. Okay. And then they've said, the CFO and the board, no share buybacks, no issuance of shares. So that'll be set to 0 by policy. And with all that, we'll be able to get our equity at end of period that we'll be able to put on the balance sheet. And then finally, the last thing we're going to project is the balance sheet, and we're going to want to solve for cash. So we're going to put everything on the balance sheet except for cash, and then we'll solve for cash by saying assets has to equal liabilities plus equity. And I'll show you how that works as we go along. So accounts receivable is going to go as 25% of sales, inventory 25% of sales, and other current assets, 10% of sales. Our PPE net comes from our roll forward equation. All these current liabilities have no special rules or dictates for them, so they're going to remain as a constant percent of sales. And as far as the debt goes, they want to retain this debt to cap ratio. They don't want to become more levered or less levered. So again, after a little bit of algebra, which is in the notes a few pages up, we're going to be able to say that the debt in year 1 is 20% times the equity divided by 80% of equity. And we'll be able to do that because we will have already computed the equity for the end of year one up here in our roll forward equation. So that's not going to cause us any problems here. Okay, and we get that equity, that 80, again from right up there. So now we're ready to go ahead. We know exactly how we're going to project everything. We're ready to go ahead and do it. So let's do this thing. So we're going to go 1 year at a time, okay? And the order we're going to go in is PPE roll forward, income statement, equity roll forward, and then we'll start in on the balance sheet. And we'll start with the balance sheet knowing what the equity at the end of the year has to be from our equity roll forward, okay? And then we can fill in everything else on the balance sheet except for cash. And then we can solve for the cash on the balance sheet using our second accounting equation here, that assets equals liabilities plus equity at all times under all circumstances. And if we expand that out, assets are equal to cash plus all other assets equals liabilities plus equity. So we could subtract all other assets from both sides, and then we would get cash equals liabilities plus equity minus all other assets, solve that for cash, and that's going to be it. Okay, so what I've got on these next few pages are the completed projections. So I've got the PPE roll forward for the next 2 years, the income statement for the next 2 years, the equity roll forward for the next 2 years, and the balance sheet where I have solved for the cash and I've checked that assets minus liabilities plus equity is equal to 0. But what I'd like to do with us now is solve for year 20x1, I'd like to solve all of these numbers with you to make sure that you're comfortable doing them. So this is sort of like a practice problem. So I'm going to jump now to this spreadsheet, and this is posted for you as well as the PDF file. And let's go ahead and just fill in all the projected numbers for 20x1, the first year that we want to project. So again, we're going to start with our PPE roll forward, then do the income statement, then do our equity roll forward, and then finish up with the balance sheet. So let's go ahead and do this. So beginning of period, PPE net is always whatever it was at the end of the last period. So that's going to be equal to 100. And we know if there's a 10-year average life of weighted average life of their PPE, we know we have to depreciate this by 10%. So I'm going to say this times my 10%, and so that's going to be my depreciation. And just to be consistent with what I've got historically, let's make this algebraically correct. So I'll make that a -10. Now the capex I'm not going to know, but the PPE they want to wind up with is 100% of TTM sales. So I do have to jump around a little bit and put in my sales for 20x1. So I'm going to say that this is equal to 100 times 1 plus, here's my 10% growth. So sales in 20x1 are projected to be 110 million. So that's where they want their net PPE to be. So now I know everything in this roll forward except for CapEx. I can solve for the CapEx, and that's equal to this minus this minus L28, and that's 20 million in CapEx. And again, always good to check qualitatively. The PPE net has been going up, the CapEx has been going up, the depreciation has been going up. It all makes sense. Okay, so 20 bigger than 18, 18 bigger than 17. It's all looking good. So I think I nailed that roll forward. So now let's go down and see if we can project what's going on the income statement in 20x1, the first year that we want to project. So we've said for COGS that we believe that COGS will remain, this makes sense, right? It will remain 68% of sales in the year. So I'm just going to say here that I want 68% times L35. So 68% of 110 is 74.8. So that's looking pretty good here. And now depreciation I have up above from my PPE roll forward equation. that's 10 million. And notice how I changed the sign here just because I'm following the usual accountant's convention that we don't put in negative signs for all the expenses here. And I'm following the convention for cash flow statements and things like that up here where we do use a proper algebraic sign convention. So you just have to remember, be a little bit careful with what you're doing here. Okay, so the SGA, even though we know it's not perfect, we're going to say that that remains constant as a percent of sales at 10% of sales. So that's going to be that 10% of our 110, and that better be 11 or we're in big trouble. Okay, that's pretty good. All right, so now I can subtotal for my EBIT. So I've got my projected revenue minus all of these expenses. Okay, and I've got my 14.2 for my EBIT, so that's looking pretty good. All right, so now my interest is, the pre-tax interest rate is 7.25 for these guys. So I'm just going to take that, and I want the beginning of period debt, so I'm going to have to find my balance sheet here. Okay, and here's the beginning of period debt. So I multiply 7.25% by 20 and I get 1.45. Okay, and now my tax is 33% of earnings before tax. So that's going to be my 33% times my EBIT minus my interest, which is L41 here. And that gives me 4.21, and now I'm good to go with my net income here. So I have my net income is equal to my EBIT minus my interest minus my tax. Okay, 8.54. And yes, I know I'm doing this in Excel, and yes, you have to do it on a calculator, but it's really very, very similar. Let's see, next up we're going to project our equity roll forward equation. So I'm just going to follow all the pieces of the equation here. So the equity at the beginning of period is 80 million, and the net income, I know I just computed that from the income statement, so I've got that, okay. And we're going to have proper algebraic sign convention here, so that's going to be a plus minus dividends. Okay, so this is going to be 15% of what? Of that net income, and that's L49. So that's 1.28. And the paid-in capital, the board and the CFO have said no share buyback, no share issuance. So now this is proper algebraic sign convention, so I can just add all these up and I get the projected equity for the end of the year 20x1 is 87.27.